Welcome to Return on Insights, the show where candid conversations with bold founders and leaders spark actionable insights for your business. I'm David Lindover.
And I'm Erin Abatangelo. Each week, we pull back the curtain with leaders who are scaling teams and shaping the future, sharing the insights that create impact far beyond the bottom line.
Discover how high-performing companies build enduring cultures, inspire teams to think bigger, and turn vision into action. If you see storytelling as your strategic advantage, you're in the right place. This is David Lindover. Thanks everybody for joining. I'm joined today by Angela Chan. She's the Executive Vice President and Chief Financial Officer of Smart Financial Credit Union, an organization based out of Houston, Texas. Angela is joining me today to talk about trends shaping the future of consumer debt. Certainly a hot topic in the industry here in North America and probably around the world, given current financial situations and macroeconomic trends. Angela has been gracious enough to spend some time talking to us today. And so I want to turn it over to Angela and have her introduce herself, and then we'll get into the topic itself. Angela?
Yes, so glad to be on the show today. Thank you for inviting me, David.
My pleasure.
Financial success and consumer lending deposits is obviously a topic that I deal with day in and day out as a part of the credit union, but I've been in the banking industry since the 1996, starting with JP Morgan Chase, and I've seen a lot of changing consumer trends for sure. A credit union is a non-for-profit financial institution, somewhat different from banks, even though we offer similar products and services, but we are not for profit, so we don't pay corporate tax the way banks do. Our requirement for earnings is just really grow enough to sustain our capital for growth. And so we focus on the people and really not for the profit that we can make, although we do need to earn profit to maintain our institution so we can continue to support the communities that we operate in.
Very good. Thank you for that introduction. So first off, I wanted to get your observations on how consumer debt patterns have shifted over the past 12 to 18 months. And then we'll talk more about how you're adapting to those changing patterns and what that means both for financial institutions as well as consumers.
Yes, from what we're seeing out of our, what we call members instead of customers in our credit union space, because they are actually our stakeholders and they do participate the annual voting of our selection of directors. So they participate in the success of the credit union in case of a extra profit that we want to do special distribution. They do actually get to that, even though we as an institution haven't got to that point. In the past year, we've seen a lot of our members have a declining deposit balance across their accounts, and they definitely have taken on more debt. For example, they utilize their discretionary overdraft protection a lot more frequently than, say, during the COVID years, where there's less spending and excess building up of balances in their deposit account. We've also seen people starting to take out a lot more unsecured loans and line of credits. And although we currently do not offer credit card, from what we're seeing, people's credit card balances are also increasing. So consumers are definitely taking more and more debt.
Okay. And what does that mean for financial institutions, and how are you adapting your approaches to support these clients that are now facing a lot of challenges, I would imagine, with interest rates still quite high?
So one thing is that it depletes the deposit balances, which depletes some of the liquidities that we do have. As a credit union, we depend on consumer deposits primarily as our funding source. We don't tend to have a lot of commercial deposits. We don't tend to like to borrow funds or utilize other mechanisms to access the capital market. So that's our bread and butter as funding source, and that's our concern. Now, some of the consumers, while they are increasingly utilizing different debt products, we also seeing a segment of our consumer population that's within our membership that actually has built up their savings and deposits. For example, the segments of the population that's been in the workforce for a while, they have highly technical skills that are in demand. Their jobs are secure. So they do build up savings and their demand for financial products continues to show that they have a healthy access to liquidity and savings, they will be buying autos, they'll be buying homes, and based on the loan amounts that we're seeing, that segment of the consumer population is actually still maintaining and doing quite well. It is the ones that's more of a paycheck to paycheck that's definitely of a lot more concern. Out of the transactions that coming through our financial institution, we're also seeing people who have any excess funding investing outside of what the traditional financial industry is providing. So they're investing potentially in cryptocurrency, sending money to their brokerage accounts. And ideally, if some of those liquidity that is a other investment can come back to the banking industry, I think that in general, it would support the liquidity and the deposit balance a lot more. But I think people do take that into consideration when they manage their account balances, and we'll see money coming back in that is above and beyond their direct deposit.
That's interesting. I hadn't thought of that, Angela. So I guess you're saying that segment of the population, the paycheck to paycheck group, is taking more risks with whatever financial instruments they have at their disposal, their savings or whatever's left of it, and investing it in higher risk, higher return
Correct.
positions.
I hear people talk about putting money in a self-directed trading account with a brokerage firm because it's easy now, right? Everything is digital. You can quite easily set up a personal account just like any other bank account and do your own trading, although a lot of people are uncomfortable. But a segment of the population, even though they are paycheck to paycheck, if they set up some, they're playing, so to speak, they're playing the market, they're taking some risks. And maybe it's a good thing because they are willing to utilize that excess liquidity to their advantage. Hopefully, though, is that they're not too ultra risk tolerant to where they put everything into extremely high risk category and end up losing most of it.
It sounds like there's certainly a risk of that happening. We certainly hope it doesn't happen, but I guess desperate times, desperate measures for some people. And that's a scary thought, right? But we won't delve into the negative. We'll try to stay on the positive side of the equation.
Right. And then the ones that are more risk averse, they do transfer their excess funds out of our institution and maybe investing in higher earning accounts with the likes of Capital One, Ally Bank, where they're paying higher than market because they don't have the traditional infrastructure of physical branches that they have to support. So that's definitely a challenge, but it gives consumers options. You may have to wait a few days for your funding to be transferring back and forth between institutions, but then they earn the higher yields while the money is parking there. Although I will say a lot of our members tend to like to come into our branch, call our call center, talk to our people. We don't have a huge waiting line. And over the years, we build up great relationships with them, which really helps us to achieve our new purpose statement of helping people achieve success along their financial journey.
That's interesting too. Is the institution that you work for adjusting its approach in any way to perhaps show a greater return to some of those current customers that are parking their money elsewhere for short periods of time? Or
Yes, we're definitely working on restructuring, adding some of our products. We try to price ourselves somewhat in the middle of the market. We're pricing slightly to quite a bit below, higher than banks in terms of deposit yields, and our loan cost is lower than banks. But we try not to be the lowest pricing town because I think going into a price war among credit unions is really not something that anybody in the industry should be doing. We should be focusing on what differentiates us, what offers our members and customers something that will cater to their needs. Lower price may be something they want at one point, but then better service, access to products and services at the time that they need is more important, or else financial education, access to a counselor, right? So there are different things that could be added to the mix. And for us, it's a balance. In terms of offering the people that are yield chasers, we do have CDs that are quite high in their interest rate. And those are the things that people can invest in, we adjusted our money market interest rates. And we even created an extra tier. We used to stop at $50,000. We created $100,000 tier. And actually just took a peek not too long ago. Some of the highest deposit balances are in those over $100,000 tier for our money market because they have immediate access to that money. But while the money is parking there, it's earning them higher interest rate than peer banks and credit unions. We do adjust our products to where it makes sense for us. But overall, our strategy isn't to be doing a rate comparison and for the rate chasers because we want member loyalty. It's just not transactional.
Makes good sense. Makes good sense. Very proactive approach. Your perspective on emerging trends, so thinking ahead now, that are going to shape consumer debt in the next year or two, at least the management of that debt. What is your institution's thinking now? And do you have any guidance for our listeners?
Definitely will be volatile, I think, with the uncertainty from inflation, from tariffs, from even the job market. We're seeing a lot of people are concerned about layoff. Even friends that I have that work for different areas of the government, they don't know whether or not they'll have a job in 3 months, in 6 months. And some of their friends have already been laid off. So there's a definite concern and fear there. And then from a consumer pricing perspective, tariffs is definitely going to push prices to go up. And so if everybody's paying more for the same products and services and their salary is not increasing by the 10% tariff rate or 25% tariff rate, they're going to hurt. So it's definitely going to impact consumers. Now, to what pace some of these changes is truly going to materialize remain to be seen, but we're bracing for impact.
Yes, I think we're all bracing for impact. It's been a very, very informative session, Angela. I appreciate your time. I'll offer you an open mic if you want to address any other issues, talk about your institution anymore, and offer any guidance to our listeners above and beyond what you've already given them, which we appreciate. Anything that you want to cover?
Sure. Personally, I would just like for all of our members to learn to be prepared because changes are constant. We never know what kind of events and activities going to happen. Being here in Houston, we've gone through freezing weather that is unseen in our history. We've gone through a lot of flood. We continuously to hear other natural disasters happening around the country. We see geopolitical challenges and mergers and acquisitions is constantly happening. So in terms of change, it's all around us. Be prepared, be proactive, say where you can, be forward thinking and looking. And part of the reason why we're offering financial counseling to anybody who has that need for free is to help them navigate and be prepared, be proactive, have a plan in mind, even if they don't yet have the funds. And for those who have the funds, be smart about it. We're not a financial advisor, but we're at least helping people to think about it. And if they need to hire somebody professional, they have at least enter into that thought of looking for one. And at the end of the day, there's always going to be change, but there should not be a fear either, right? Life is tough as it is. Take it one step at a time and enjoy what we can. Just have that open mind and be willing to be flexible. Even if laid off, I know sometimes people don't want to take a step down and get a job that's lower pay, but it's nice to earn something while you're waiting for that next ideal job. Start the new business may not be a great idea, but if it's something that you know you do well, at least start on the side, have a gig. And talking about that gig economy is also a big thing. A lot of people on the side, and that includes some of my colleagues as well, do Uber driving and whatnot. Now, that's not for everybody, but it is about being prepared for the future and be proactive about it. So wherever people do, have some fun, but be concerned, but not be fearful, because live life to the fullest while you can.
Great advice, Angela. Wonderful. Thank you so much for your time.